August performed as expected, killing the summer stock rally and delivering a lousy month for markets. And now that September is here, investors are bracing for another potentially volatile month. So let's take a look at some of the biggest risks that we are watching for the month of September here. First up, it could potentially be another cruel month for stocks. Now, a few things that we're going to be watching, of course, the earnings that continue to flow through. You've got some household names that are going to be reporting over the course of this week, as well as some Reddit or retail investor names, GameStop, that's going to be set to come out. But I think more largely here, even as we think about the market performance, it's also going to be the amount of volume that we also see come forward and perhaps rebound from August, which is typically one of the months where many of the traders at desks, they kind of take that time, use vacation, and kind of using Labor Day perhaps as that kind of flank post, if you will, that really triggers, or, some of that vacation time triggers lower volumes. But even at this time where we're still going to be set to hear from some companies over the month of September, you've still got names in retail. You've still got some of those household known names, and it'll give us a little bit more of a sense of where the consumer stands right now.
I mean, as we saw from that chart, historically, September does tend to be negative for stocks pretty clearly. Although, as our Jared Blickery wrote in the morning brief last week, he pointed out that performance, the average, is really dragged down by several sort of anomalous Septembers out there when we've had big events, big downturns that have pulled down that average performance. If you pull those one-time big declines out, it doesn't look quite as bad, but we'll see how this September pans out. But that's definitely one of the risks, sort of seasonality. Another risk that we are watching for: the United Auto Workers are edging towards a strike, and there are different estimates here for how much that is going to cost the U.S. economy. One of those estimates from the Anderson Economic Group says even if a strike lasts only 10 days, we could see nearly $1 billion hit for the three major U.S. automakers, and that we could see losses mount up to about $989 million for those companies, nearly $1 billion, and wage losses as well of $859 million. So definitely that's something to keep an eye on, as well as a potential risk that could trickle through into the broader economy.
Yeah, interestingly, not something that came up on the most recent earnings calls for companies like GM or like Ford, but when you think about the hits to what this means for their electric vehicle production as well, a time where they're investing billions of dollars, have these significant their own posts, or at least goals that they're guiding towards, and this could throw a wrench in that plan. Just a matter of the year that we've seen in terms of negotiations playing out in labor unions or unions at a whole here. This is just another one that car manufacturer investors out there have to consider, and what that would essentially mean to being able to get some of those new vehicles back into the dealerships as well. So that also, as we're watching one more big theme that could potentially play out over the course of September, and that is geopolitical tensions. They continue to rise here. And now, there are a few ways to look at this. And of course, China has gotten a lot of the attention, and rightfully so, for the second biggest economy in the world, and lagging some of the growth projections that we had seen. You've already watched Goldman, Citi, JP Morgan cut some of their GDP forecasts, Citi sitting at about 5%, and the World Bank, even for the projections that we've seen come forward over the course of this year. It's a larger question of where, moving forward from here, China takes actions that the market does not foresee coming in order to spur some type of economic growth as well. Yeah,
so you have sort of the economic backdrop squarely situated around China, and then you have sort of the geopolitical backdrop as well. News today that Kim Jong-un of North Korea is planning to visit Vladimir Putin of Russia. News as well that Xi Jinping of China is not planning to go to the G20 in India. So those concerns have sort of faded into the background when it comes to market perception, at least, and market participants watching these items. But still, anytime any of this stuff sort of flares up and becomes more acute, could be a further risk to the market. So that's something else that they're watching. So we have three risks that we're watching, but we got one catalyst as well, because there might be some hope for markets after all. Corporate earnings could be a catalyst, as our Miles Udland wrote in this morning's morning brief. He pointed out that if you look at FactSet estimates for estimates coming down for earnings versus estimates going up for earnings, we're actually seeing revisions higher here earlier in this quarter, which is quite unusual. We haven't seen it happen since the third quarter of 2021. So could there be sort of a trough in the earnings performance, that could be one of the reasons that we have seen markets hold up fairly well.
Yeah, and for the results that have come in, we've largely been looking at companies that have been beating on some of the expectations that have been at the lower end of what investors perhaps looking for in this larger kind of growth environment, what they were looking for or hoping for at least. And so just beating on or having a relief move after beating on already kind of suppressed, if you will, not suppressed, but not great expectations.
Yes, lowered expectations.
Exactly.